In 1983, something unusual happened. Gold, the world's safe haven asset, suddenly crashed even while global uncertainty was rising. And now, over 43 years later, markets are starting to see similar signals again. And gold just had one of its worst weeks in decades. Now here's what makes this even more surprising. So gold and silver dominated markets in 2025, rising approximately 70% and 160%, marking one of the strongest performances since 1979. At the start of this year, many economists and financial experts were strongly bullish on gold, expecting continued gains due to global uncertainty and geopolitical tensions. Because we know gold tends to rise during periods of instability, and we saw this during events like COVID-19, major recessions, and global conflicts. Because gold is considered a safe haven asset, meaning investors move into it when uncertainty increases. But this time something unusual is happening. Despite rising geopolitical tension and ongoing conflict in the Middle East, gold prices are falling instead of rising. So this is a major concern that we are seeing right now. What's really going on? Why is gold dropping during a time when it should be increasing? And is this a temporary correction, or are we seeing patterns similar to the 1983 gold crisis? And how are the latest Federal Reserve decisions, the US dollar, the treasury yields influencing all of this? In this video, we will connect all the dots and explain what's happening and, more importantly, what it could mean for your investments. But before we begin, my name is Jack Cross, and on this channel, we connect global events to your investments. Because when you understand the economy, you make better financial decisions. And last week, gold dropped nearly 9 to 10%, marking one of the sharpest weekly declines in years, and one of the biggest moves since the 1983 gold crisis. Which is exactly why the market is paying attention. So what's causing this sudden drop? And more importantly, why is gold falling during a time of war when it's supposed to rise? To understand what's happening today, we have to go back in time and look at what happened in 1983. So take a look at this chart. This is the weekly percentage change in gold prices. And if you focus on the red line, you'll notice something interesting. The recent drop is approaching the same level we saw back in 1983. So why did gold crash during that period? And to understand the gold crash, we actually need to start with oil. So during the 1970s, the world experienced two major oil shocks, one in 1973 and another in 1979. Oil prices surged dramatically, and for a period of time, Middle Eastern oil producing nations were generating enormous revenue. But high prices created something unexpected: competition. So countries like the United Kingdom and Norway began aggressively increasing oil production in the North Sea. And by the early 1980s, the global oil market was flooded with supply, and this period became known as the Great Oil Glut, where demand slowed, supply increased, and OPEC nations suddenly saw their oil revenue collapses. And this is where things get interesting. Many oil producing countries had spent years expanding infrastructure, funding government programs, and increasing public spending, assuming oil revenues would remain high. But when oil income dropped, these countries suddenly faced massive budget deficit. They needed liquidity fast. So they turned to one of the most valuable assets they held in reserve, that is gold. So in early 1983, several oil-dependent nations began selling portions of their gold reserve in order to stabilize their economies and to cover budget shortfalls. This created a wave of selling pressure that the gold market simply wasn't prepared for, and the result was a sharp decline in gold prices. So in late Feb and early March of 1983, gold dropped significantly in a very short period of time. On one trading day alone, gold fell more than $40, marking one of the largest single-day declines at that time. Investors who believed gold would remain stable during economic uncertainty suddenly saw significant losses. And this wasn't just a normal correction, it was a major shift in global capital flows. Now let's fast forward to today. So the Strait of Hormuz, one of the most important oil shipping routes in the world, is facing serious disruptions concern. Roughly 20% of global oil supply passes through this narrow waterway of 34 kilometers. And as tension increases, oil prices have surged, with Brent crude moving toward the $115 to $120 per barrel range. But here's the key issue. High oil prices only benefit producers if they are actually able to sell and transport the oil. If shipping routes are disrupted, revenue can still decline even when prices are high. And this creates financial pressure on oil-dependent economies that rely heavily on consistent export income. And when governments face sudden revenue pressure, they often need liquidity quicker in order to maintain economic stability and continue funding public spending. And historically, gold reserves have sometimes been used as a source of liquidity during periods of financial stress. So markets are beginning to draw comparison between today's environment and the type of pressure we saw in the early 1980s. But the pressure on gold doesn't stop there. The same oil-driven inflation concerns are also impacting monetary policy expectations in the United States. Rising inflation risk makes it more difficult for the Federal Reserve to cut interest rates aggressively. In fact, recent signals suggest interest rates may remain higher for longer than investors previously expected, and this creates a challenging environment for gold. Because gold does not pay interest, it competes directly with interest-bearing assets like government bonds. At the same time, both the US dollar and 10-year Treasury yields have been rising. And historically, gold tends to move inversely to both. The US dollar index, also known as DXY, has strengthened as investors moved toward cash during geopolitical uncertainty and energy market volatility. A stronger dollar makes gold more expensive for international buyers, which can reduce global demand. And as demand weakens, institutional investors such as hedge funds and ETFs may reduce their gold exposure in order to rebalance portfolios or manage risk. At the same time, US Treasury yields have moved higher. The 10-year Treasury yield has climbed toward the 4.3% range, following strong economic data and expectations that interest rates may remain elevated. And this increases the opportunity cost of holding gold. Because when investors can earn a relatively safe yield from government bonds, holding a non-yielding asset like gold becomes less attractive. And as a result, some large institutions shift capital from gold into higher yielding assets. And when multiple macro forces move at the same time, a strong dollar, rising bond yield, inflation uncertainty, and geopolitical risk, gold can experience increased volatility. Even during period of global tension, gold may be falling right now, but that doesn't mean gold is dead. Because behind the scenes, central banks are still buying gold and physical demand remains strong. So what's actually dropping is mostly paper demand, ETFs, futures and institutional positions. And as investors shift money into assets offering higher yields like US bond, remember gold doesn't pay interest. So when bond yields and the dollar rise, gold often faces short-term pressure, but historically gold has moved in cycles. Periods of strong dollar and high interest rates can push gold down temporarily, but long-term demand often comes back when financial conditions changes. So the bigger picture is this. Gold isn't disappearing, the macro environment is shifting. And when interest rates, inflation expectations, or global risk change again, gold can quickly come back into focus because gold doesn't just react to headlines, it reacts to liquidity, interest rates, and global uncertainty. And understanding this connection is what helps you make better financial decisions and investment decisions. So I'm Jack Cross, and on this channel we connect global events to your investments, and I'll see you in the next video.